So a lot of people think that filing a tax extension grants them with more time to pay their taxes, but it does not. A tax extension grants you more time to file your taxes. It does not grant you more time to actually pay the taxes you owe. And there is a big difference here because there's a number of penalties that you can end up paying if you're not careful, like the failure to pay penalty, the failure to file penalty, or the failure to submit your estimated tax penalty, which could end up costing you several thousands of additional taxes, fines, penalties, and interest if you're not careful. These penalties usually catch people by complete surprise. So as a licensed CPA that helps people reduce their taxes and avoid these penalties every day at mycpacoach.com, I want to provide you with a very simple and easy to understand guide to help you avoid this altogether. Okay, so for whatever reason, let's say you need to file a tax extension. Maybe you're missing tax documents, financial documents, or have a pending tax issue going on, or maybe you're just dreading your next tax bill. I get it. So maybe you or your accountant decides then that you need to file a tax extension and you agree to it. But what exactly does that mean for your taxes? A lot of people blindly agree to a tax extension without understanding the potential consequences of it. So let's talk about what a tax extension actually is. So a tax extension is simply a request to the IRS asking them for more time to file your tax return. And if accepted, you will be granted an additional 6 months to file your tax return without being subject to any late filing penalties. It's very important that you understand what that means and how it differs from the other penalties that you may still be subject to. So let's say your tax return is typically due on April 15th, and you know for a fact that you are not going to make that deadline. Well, if you do not file a tax extension and you file late, then you would be assessed a failure to file penalty, which is equal to 5% of the outstanding tax due for each month the return is late, up to a max of 25%. So for example, let's say you owe $10,000 in taxes and you file your return 5 months late. Well, your failure to file penalty would equal $500 per month that you were late, which would cost you an additional $2,500 in fees plus interest. But if you file a tax extension, you would avoid these late filing penalties altogether and the added interest expense. So if you are going to file your tax returns late, then it is very important to file a tax extension before your tax return due date to avoid this penalty. But that's not the only penalty we have to worry about here. There is also the failure to pay penalty, also known as the late payment penalty. So here's the thing, your tax payment and your tax return filing are treated differently from a penalty perspective. And the interesting thing here is that the IRS will grant you more time to file your tax return, but they will not grant you with more time to pay the taxes due on that tax return. They want their money on time. So even if you file a tax extension, you can still be subject to the late payment penalty here if you do not pay your taxes by the original due date. For example, let's say you filed a tax extension for the same tax return that you filed 5 months late and owed $10,000. Well, if you paid the $10,000 5 months late, you would likely be subject to the failure to pay penalty, even though you filed a tax extension. This penalty is equal to 0.5% of your unpaid taxes for each month that the tax remains unpaid, up to a max of 25%. So if you pay your taxes 5 months late, that 0.5% penalty would cost you an additional $50 per month for a total of $250 in penalties plus interest. And the only way to avoid this penalty is to pay your taxes in full by the original due date. For example, if you submitted the $10,000 payment before your tax return deadline of April 15th and filed your tax returns 5 months late with that extension, then you would not be subject to this penalty at all. But this can be difficult for many people because it's like, how can you pay the taxes you owe on a tax return without a tax return being prepared that properly calculates what you owe? You would basically need to calculate your tax bill in advance and then subtract any tax payments you have already made through your W-2 tax withholdings and or estimated tax payments. And speaking of estimated tax payments, you can also be penalized when you file your tax returns if you are not compliant with those rules as well. So let's talk about the underpayment of estimated tax penalty. So look, not only does the IRS want their money on time and by the due date of your tax return, but they even want it during the prior tax year if you expect to owe more than $1,000 in taxes when you file your return. For W-2 earners, think about the taxes that are already being withheld from your paychecks. Well, if you don't withhold enough taxes from those paychecks, then you may be subject to this penalty. And for non-W-2 earners like self-employed individuals and 1099 contractors, then you should be making what is called estimated tax payments to the IRS each quarter, or at a minimum before the end of the tax year if you can. Otherwise, you may be subject to this penalty. But how much should you actually submit in estimated tax payments? Well, in general, your payments in tax withholdings must equal at least 90% of the tax shown on your current year tax return, or 100% of the tax shown on a tax return in the prior year. And if your adjusted gross income exceeds $75,000 as a single taxpayer or $150,000 as a married taxpayer, then your estimated tax payments for a prior year tax return should be 110% of the tax owed. Now, as a CPA, I usually tell my clients that it is much easier to make these payments based on your prior year tax return, as opposed to trying to calculate the current year's tax bill, which can be very complicated to do when you're in the middle of a tax year already. So keep things simple, and remember, the failure to file penalty and the failure to pay penalty are all based on your unpaid taxes. So by paying your estimated taxes, not only do you avoid this estimated tax penalty, but you also minimize any late filing or late payment penalties you may have at the same time, because paying your unpaid tax will make that tax due even lower, or in some cases, non-existent. Plus, this is not really the rule, but in my experience as a licensed CPA, I rarely see my clients owing any late payment penalties when they are in compliance with the estimated tax rules. So I always tell my clients to pay their estimated taxes. That way, if we have to file a tax extension, we don't have to worry so much about those late payment penalties. So if you are filing a tax extension, let me know what you think about this in the comments below. And if your CPA is not helping you minimize your tax liability and penalties like this, then consider upgrading and applying to work with one of my CPAs today at mycpacoach.com.